Okay, we're going to move on now to look at the industrial sector in Brisbane. In some ways, industrial has been impacted in a similar way to the office sector, in that the occupational side has been hit quite hard, and we've seen some pretty dramatic falls in certainly pre-leasing and construction activity. But on the other hand, there's been still a lot of interest from investors to get into the industrial sector, especially for the quality stock, and we've seen that certainly in the CBD office market as well. You know, the sort of dislocation that's occurred in the Queensland economy in the last couple of years has caused some indicators to change, which don't normally change. For example, traffic through the Port of Brisbane has actually fallen for the first time in 15 years. So you're starting to see some things happen for the first time in 15, 20 years. Such has been the quite sharp and severe downturn in the last couple of years. When we see this, of course, we know that the demand for industrial real estate also falls, and it's not just in Brisbane, but it's across the eastern seaboard. In fact, it's right across the world that we're seeing container traffic pull back, and as the demand in the economy has also dropped over the last couple of years. We've just actually put together a global industrial report for the first time in our company. We've done that out of Sydney. We'll be releasing that next week, and you'll see some of the results of that and the impacts of the downturn in industrial markets around the world. But we are actually forecasting an upturn in the industrial sector as that economy starts to move up, industrial production moves up, all those things that Ray Tordo was talking about earlier. But back to Brisbane, it means that the construction activity has fallen quite dramatically, and over 1 million square metres of industrial floor space was completed in Brisbane for the first time ever in 2008. That construction activity has dropped 70% since then to be around 300,000, just 300,000 square metres this year. So it's a pretty rapid downswing, and it's really all based around pre-leasing, which in some ways has actually helped preserve the market, because pre-leasing drives it up, and without that demand and financing, it brings it down pretty quickly as well. We know that there's an enormous amount of projects in the pipeline that are approved, ready for construction, and there's land ready to go. And if all those things were to turn around and the pre-leasing come back strongly, the market could deliver 700,000 square metres again next year. We know that that's pretty unlikely. It's more likely to be perhaps around 400,000, 500,000 as the market sort of more gently moves up. And particularly the pre-leasing, which seems to be missing in Brisbane at the moment, is the one thing that we think should come back in the next 12 months. It's certainly coming back around the rest of the country, so Brisbane should be next. Expressed another way, if you look at the share of construction activity in the various different sized industrial properties, you can see that warehousing has represented close to 30% recently as the big logistics operators started to move up to southeast Queensland. But of course, that activity has disappeared, and warehousing now represents less than 10% of the construction activity. But you can see how much could come back. It may within a few years, represent as much as 50% of the construction activity in the industrial sector if that pre-leasing returns. We think that's had an impact certainly on the rentals here. We think the average rentals across Brisbane in the Grade A sector have fallen about 8% over the last couple of years, a little bit less than the national average, although rentals here are still about 10% above the average for Australia. One of the biggest legacies of the industrial in the industrial market over the last couple of years has been a fall in land prices, and we've seen this around Australia too, especially in Perth for similar reasons. In Sydney and in Brisbane, we've seen land prices for better quality located property fall about 30%. For property that's perhaps away from motorways or the infrastructure, could have fallen as much as 50%. Thankfully, that's now stabilised, and it has actually provided better feasibility equations for new construction activity. So it does provide the opportunity now for owners to get that construction activity underway once the pre-leasing comes back. And when it does, we know that from the monitoring we do, that's the Western Corridor that has the bulk of the undeveloped and unoccupied land ready for development activity. Turning to the investment market, I mentioned that the amount of interest in industrial has remained pretty high, and you can see around $400 million of turnover has occurred in Brisbane in the last couple of years, and somewhat against expectations, given the way that occupational side has dropped away so significantly. But it's a similar story around Australia. For prime quality, for the longer term leases and for better located property, we're still seeing plenty of demand for industrial property. And we think that given that yields have blown out so much in industrial, more than anywhere else, that it's reasonable to expect to see some measure of yield compression, especially now there's a bit more evidence coming through with that amount of investment activity. The average yield is around 8.7% nationally. We think it's reasonable to call for about 25 basis point softening before maybe even the end of this year, and perhaps a little bit more into 2011. And certainly that's what our forecasts call for. And without significant change in the rental side, it's quite possible that you'll see capital values rise in the industrial sector next year, maybe even more than any other property sector. So it's a rare time when industrial is at the top of the rankings in terms of property value increases over the next 12 months. Let me summarise the industrial sector by saying that we think the demand drivers for industrial have now bottomed and we're waiting for a turnaround. Pre-leasing of larger stock we think should start to happen next year in Brisbane. That's the one piece of the equation that's missing here, but it's certainly returned quite strongly in Sydney and Melbourne. We know that there's a significant pipeline of projects already stamped and approved and ready to go, and the bulk of those are out in the Western Corridor. Look, we think rents will sort of stabilise largely for 2011, but again, that 2012 year is shaping up when we think that there'll be stronger activity that will push rents up back to the sort of CPI-style growth of 3 to 4% in 2012. We think the investment attraction will continue and probably even strengthen over 2011, and that should give some more impetus to see yield compress across that whole sector. So don't just take my word for it. Let's hear from the man who's out there on the coalface every day. Please join me in welcoming up to the stage this morning, Ed Bull.